50-year mortgages. Well, you could save almost $266 a month on a typical loan, but let's talk about the drawbacks. Hey, it's Rachel Toms with Be Inspired, and today I'm here with Missy Baker of Movement Mortgage here in Asheville. She's a senior loan officer, and she is going to pull back the curtains on that 50-year mortgage talk and let us know what it's really all about and if it could be a positive thing or a negative thing for the home buyers today. Thank you so much for being here, Missy.
Thanks for having me. I appreciate it.
50-year mortgages. Did you ever think you would see a time where this was, I know it's not agreed upon or put into act right now, but did you ever think that we'd see this day where people are talking about a 50-year mortgage?
I don't think so, but if you go back 50 years.
So we're in like 1975-ish?
Yeah,
Okay.
or 60, 60 years ago, our parents were probably only doing 10 and 20-year mortgages because houses were, say, $50,000, where now that same house is $400,000. I see where the government is saying, let's do 50-year loans because prices have increased like that.
Yeah.
But 50 years is a really, really long time. And my thought process with it is that unless they put a lot of money down and automatically walk in with equity, they're never going to build up enough equity and deal with the appreciation. Like they're going to be paying more interest. It's going to be more like a negative AM deal where you're paying an interest-only payment because essentially you will be only paying an interest-only payment for the most part. The other thing with the 50-year is that the finance charges, the interest on it is going to be astronomical. It's probably going to be
the rate or the interest you pay over the life of the loan?
The interest that you pay over the life of the loan. Over the first 20 years, you're going to be paying mostly interest. And in turn, if you compare a 30-year and a 50-year, you're going to pay probably twice as much, $400,000 extra.
Just an interest
Just
alone.
an interest.
Woo! So that $266 a month on the typical payment probably is not going to get you very far if you're not actually purchasing the home for 20 years. Did I hear that correctly?
Correct.
Yeah.
And then when you go to sell the house, you're going to be upside down.
You're paying interest only for 20 years, meaning that you're not chipping down at that principal of the home. So you're not building any equity. And even though the house is appreciating, it doesn't necessarily mean it's going to appreciate at the same rate that you need it to. Is that correct?
Yes. Yeah.
So when you go to sell it, I didn't mean to interrupt you. So what is a potential pitfall if I took out a 50-year mortgage loan today and I wanted to sell in 5 years? What could potentially happen?
In 5 years, let's say you only put 10% down.
Okay.
You're still going to owe the same amount that you borrowed because all you've paid was interest during that first 10 years or so.
So you're basically renting the house from the bank.
Yeah, essentially.
That seems like not a great proposition if you want to purchase a home, because the idea is, well, I mean, there's a few different things when you buy a home. It's, you know, that you don't have to move. If your landlord decides to sell the house, you know that, I mean, if you own it, you don't have to do this kind of dance. However, you're not building equity. So the idea that you're building wealth and an asset is just null.
Right.
Because you're paying that interest to the bank.
Exactly. And then let's say the market has gone down. There's been an upset in the market, or there's been an adjustment that's been negative, like a lot of people are seeing right now. There's going to be people that are going to have short sales and foreclosures because they owe more than what the house is worth.
For the viewers that don't know what a short sale is, could you just summarize that?
So let's say you borrowed $500,000, and 10 years from now you still owe $500,000, but the market has had an adjustment and it's only worth $490. So you're going to have to bring either $10,000 to closing, plus your closing costs, which on a sale is not that much, but some people don't have that $10,000. They're going to end up doing a short sale where the lender says, I will agree to a short sale. I'll only take $490, and then they write off the other $10,000, but it affects your credit negatively.
And if I'm not mistaken, even if they agree to take less than you owe, don't they write? I know they write off that $10,000, but doesn't it count as income towards you, the borrower?
When you go to do your taxes the
Yeah.
next year, yes, it's going to count as a capital gain because they wrote off that $10,000.
It's a ding on the front end, a ding when you go to sell it, and a ding when you file your taxes.
Yeah. I mean, if everybody did a 50-year loan, think of it like if everybody did USDA loans and put no money down
Yeah.
and tried to sell the house in 5 years, and the housing market didn't really appreciate that much, they're going to owe the same thing. And they're not going to have a down payment for the next house.
Right.
It's creating a huge monster.
I think the majority of lenders and people that are in the real estate market see it for what it is. Maybe it's attractive. I think you could potentially say that it's going to open the pool of buyers because now people are able to qualify for more than they would have been able to qualify for. What would you say to somebody who was sitting here with you and they were saying, this is fantastic because it's going to bolster the housing market. We're going to have more buyers, more lenders will be making loans. It's going to be really positive for the housing market and real estate market overall here in Buncombe County. That's where we're sitting, but in our region, what would
Yeah.
you say to them?
I would say that it will initially, but then when those houses start to go on the market, you're going to see a lot of foreclosures. It's going to be like '08. And there's going to be so many people that are upside down in their houses. And I think that's a major ethical
Yeah.
disservice to the homeowner because it's giving them a false sense of security.
Absolutely. And I mean, I bought my first house in 2009, September 2009 to be exact, the end of September. We bought it on a Friday. And that following Monday, we got the news that all the big banks were failing. It was our first house. We bought it for $80,000. We had a USDA guaranteed loan, which is not direct from USDA, but it's guaranteed. So we didn't put anything down. And then when we decided to move from Chapel Hill to the mountains, guess what? We were in a pickle. And so we couldn't sell because we couldn't bring money to the table to do so. I can't remember. It would have been probably 10,000, like in your
Yeah.
example. So we ended up holding on to that house and renting it. We finally sold it and broke even in 2016. Well, it's not the same thing. We didn't take out a 50-year mortgage. It was a similar impact.
Yeah.
We, didn't build any equity. We didn't know. It was our first house. We're excited to just be buying.
Yeah.
So it created a false sense of adulting, so to speak.
Yeah.
Yeah.
And I would say that if they were to do something, and it's just something that they're talking about doing. I don't know that it will happen, but if they do, I would hope that it would be required that you had to have you couldn't do it with 5% down, or maybe even not with 10% down, because the house is not going to appreciate enough in that situation.
That's a good point. So putting some I guess
Kinda
that
like
remains to be seen.
Kind of like a reverse mortgage.
That's exactly what I was just thinking about.
Yeah. A reverse mortgage, they have to walk in with a lot of equity.
Mhm.
And it's for the same reason, because they're not making any payments to chunk down at the principal so that when they go to sell in 10 years or so, they're not upside down. So I think that's what's going to happen. I think if it were to come to fruition, they're going to require that you walk in with a lot of equity, because it would be the only way to go.
Which actually is counterintuitive, because if the idea is to create a housing market where more people can afford to purchase a home that couldn't qualify for a 30-year mortgage, I mean,
They're not
let's
gonna
just be
have that
honest,
much
they're
money
not going
down.
to have that much to put down.
Yeah.
So these would be, like you're saying, probably somebody who needs a lower down payment in order to do so. And while it might seem like an attractive option, it's something to really think about before. And obviously it's not available right now, but it's something to really think about and talk to a trusted lender about, and just have them really go through the fine print with you because it could get you into a pickle like I once was. I'm not embarrassed to say that. And then you learn from it, but if you don't have to do it, then that would be even better. It'd be
Yes.
better for your first-time home buyers, people that want to get into the market to be able to buy a home that they are building equity in, because that's how we're building wealth these days, to pass on to our children, to our loved ones, whatever it might be, just to have that equity to buy your next home. So, any last thoughts before we sign off on this one?
No, I think we've discussed and figured out it's a negative.
I think we burst the 50-year mortgage bubble right here at Movement
think so.
Mortgage today. Thank you so much for joining me.
Thank you for having me again.